Welcome. Startup hires can, even very sophisticated people, can lose the upside or miss out on the upside of joining a startup if they lose track of sort of the big picture themes of startup equity, the basic principles of what it means to be at a startup. It's very easy to do when you're getting into the details, all the weeds of restricted stock and stock options and RSUs and all the fine print details. So this video is designed to outline the basic principles or themes of startup equity to help you see the big picture. You can consider this sort of the secret key to my blogs and my courses to help you keep your eye on what's important. I'm Mary Russell. I'm an attorney and I work with individuals on their startup equity. I also teach courses and blog on the topic. The purpose of my practice and my content is to help individuals make the most of their startup equity opportunities. So here we go, on to the secret keys of startup equity. The first thing to think about is that a startup, in its sort of classic form, is started by individual people with an idea. The classic would be they're in a garage and they're making some new technology just between a couple or few people. That's the classic startup. Individual founders. It's not something traditionally that's created by investors from the start or created out of something that's an established value and then built from there. It starts with human beings getting together to create something. Now, this principle applies to startup equity because this company is going to be owned 100% by the founders, these individual people who are also working for equity from day one. They're not getting paid by investors from day one. They're working for the stock in the company that they've created. So this is important to remember because ideally, the founders and the individuals who are joining the company as executives or employees or advisors are aligned in that they all have this stock incentive as part of their compensation structure. So might seem obvious, but just want to call these basic principles out so they're not lost as you're getting into the details. Everyone's in it for sweat equity, as in the sweat of their brow, contributing to the growth in the value of the company. Now, the next principle is that a startup is designed, and the growth in the value of the startup starts from nothing. It starts from an idea. Now, there are exceptions to this. There's startups that are founded with intellectual property that's spun out of another company or out of a university, certainly within the range of normal of startups. But you want to think about a startup as creating something out of nothing with the idea of growing in value astronomically over time, but from nothing. Now, this principle is important for individuals in their equity compensation because founders, in order to do this amazing feat or achieve this amazing feat, they need other people to help them do it. You can't do this alone or with another couple people. You need a team. So they use equity compensation, stock compensation, to recruit, retain, and motivate their talent to create along with them. So always in the back of your mind that there's this promise that if the company grows in value and they successfully create something out of nothing, these individual contributors are going to have a huge growth in value in terms of their stock and their personal net worth as well. The third principle is that startups raise money from venture capitalists, otherwise known as VCs, venture capitalists. It's a very specific type of investor. Classically, there was sort of a handful of these venture capital firms on Sand Hill Road in Palo Alto, and they worked with ideas and people coming out of Stanford, and that was sort of the classic model or classic geography of what it meant. And there's still the classic venture capital Silicon Valley model of startup companies funded, fueled with the growth is fueled by venture capital investments. So they sell stock to these investment firms and use that money to fuel the growth in the value of a company. There are some variations. There's self-funded companies or companies that are, or investment firms that are more like private equity than like this specific subset of private equity, which is venture capital. But we're talking about venture capital as distinct from private equity, in that private equity is more like investors who are trying to flip a house, let's say. They're trying to take something that's already of value and recreate it in some way so it continues to grow in value or maintain its value over time. I'm getting too far off track, but that would be kind of an analogy of what a private equity investor is. That's not what we're talking about here. We're talking about startups being funded and fueled by venture capital investment, which is riskier and more, like we said before, starting something from nothing, and we hope then achieving huge growth in value for the investors and the founders and the employees, et cetera. Now, what makes venture capital, how this relates to equity compensation is that venture capitalists have a very specific capital structure, how they expect a company to be structured from day one and change over time. There's not a lot of variation in the capital structure of these companies. So, I mean, I love working with interesting, creative people. It's interesting and exciting, but there's only so much creativity that can be applied to structuring a startup equity grant. There's going to be certain terms that are not going to be on the table within the world of venture capital funded companies. For instance, you're not going to expect in any venture capital funded company to have anti-dilution protections in an employee or an executive or a founder's stock grant. It's just not on the table in this world because dilution is part of the game, part of the structure of a venture capital backed company or startup. On to the next principle. What makes a venture capitalist startup a venture capitalist backed startup is high risk, high reward. These companies are expecting a huge jump in value of their early stage companies and a pretty huge jump in value even of their later stage company investments. That's what incentivizes people to invest in the fund, that pile of money that these venture capitalists are investing, is the promise of outsized returns on that investment, the possibility of a huge jump in value. High risk, high reward. That's what makes a venture capitalist or a startup. Why is there so much risk? Well, all sorts of things. There's market risk. Things might change in the market. There's technology risk. Maybe this technology isn't going to turn out to be as successful or as lucrative as people expected. There's execution risk. Maybe the business itself can't get it done. There's financial risk. It's all over the map because we're talking about creating something from nothing. Getting from 0 to $1 billion in value is exciting, but not everyone is going to be a hit. If you think about the classic example would be like very early stage venture capitalists that are investing in, let's say, pre-Series A companies, early stage companies, would expect that a third of their investments would end up being very small successes, like 1 to 5x return. Okay, they get their money back or they make some money. That's good. They're expecting maybe half of those investments or half of those companies they invest in will fail completely and they'll get zero back. Well, how can you have outsized returns if a third are okay and half are total duds, zero? Well, they're expecting that maybe 1/8 of those companies will be a big success, more than 5x return on their investment. When they finally sell their stock, it's worth more than 5 times what they paid for it. And they're hoping maybe 1 in 20 of the companies that they invest in will be 30x return on their investment, a huge astronomical success. So maybe 1 in 20 will be a 30x return. That's the kind of return that people have in mind when they think about investing in a startup or joining a startup in exchange for equity compensation. That's what they want. That's what they're thinking about. But the basic principle that we're talking about here is that venture capital is high risk, high reward. And that's all part of the deal. From the perspective of equity compensation, this principle applies in that this drives the structure of equity and the culture of the company. From the structural perspective, there's going to be a vesting schedule where people have to earn their shares over time. Very unlikely to be negotiable. Because sometimes people will come to me and they'll say, I'm very happy with the number of shares or the percentage ownership, all good, but I want a much shorter vesting schedule. Like, well, just like anti-dilution protection, it's probably not on the table. The thing to do if you want either of those things is to negotiate for more stock up front. And that's the way to address concerns about vesting schedules or concerns about anti-dilution protection within startups. Now, from a cultural perspective, the high risk, high reward culture, this plays itself out in equity compensation, and that offers are made for people, the numbers of shares in the offers are made with success in mind. So they're not going to be able to incentivize someone who doesn't believe in the company to accept stock in the company. They're not going to be able to come up with enough stock for someone who really thinks it's going to be a failure, unless they're working there for some other reason, and people join startups for all sorts of reasons besides the stock. But keep in mind that from a cultural perspective, everybody has their eye on that high reward prize, and that's built into the compensation negotiations. Now, like we mentioned before, venture capital firms are investing in companies with the expectation of dilution. We're investing funds today, and the company is selling stock today at some valuation with the expectation that they're going to use those funds to grow the company over the next, let's say, 1 or 2 years. And then after that money is spent, the company is either going to raise funds on the public markets, be acquired, or raise more funds from more venture capitalists to continue to grow the company. All of these things, besides an acquisition, would be a dilutive event. More stock is being issued, and so every share of stock is worth a smaller percentage of the company. It's just part of the deal. How this plays out in equity compensation is that companies are expecting or hoping that at each financing event, the total value of the company, the way investors are looking at and valuing the company when they agree to purchase stock in the company, we're all hoping that's going to go up, 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 up. And so with that in mind, the dilution expectation and the high growth, we're hoping that the value of the company goes up, perhaps like a hockey stick. It took me a while to get that. People are always talking about hockey stick growth. Okay, well, if you're looking at the whatever metrics we're talking about, revenue or users or whatever it is, they want to go quickly up, a little growth, and then whoosh to the moon. That's what they have in mind. for those metrics, and therefore, by analogy, also the valuation of a company. That's where we're headed. That's what we have in mind within a startup. So this applies to, or this plays itself out in equity compensation, in that I'll just cut to the chase here. The lion's share of equity that an individual contributor or executive or advisor or employee will get is in their original grant when they join the company, usually at 4-year vesting. Now, people coming from public companies that do not usually have hockey stick growth in terms of valuation or metrics might be expecting a grant every year, a grant of stock every year to vest over time, but annual refreshers of substantial equity grants. That's part of the public company world in a lot of cases. That's not part of the startup world. So the action is in the original grant. One of my very favorite compensation professionals, he says 90% of the equity you're going to get at a startup is in the first grant. And you can see, if you think about it for a second, why that would be the case. If you join when the company is worth $10 million and you're hoping that the company is going to be worth $100 million in a couple of years, the equity they're handing out when it's worth $10 million and still vesting then over time is going to be worth a whole lot more in a couple of years. So, since equity compensation is designed to recruit, retain, and motivate talent, they're not going to need to make more equity grants to retain people who are continuing to vest equity that is highly appreciated in value. So this high growth plays itself out in stock compensation, and that the first grant really is the lion's share of the equity. So that's where the action is in terms of negotiating equity compensation. There's exceptions to that, of course, and companies like to say, oh, well, of course, we'll give you more grants every year. We would, of course, do that. But they just don't because they can't afford to do that. That's just not how it works in startups. Now, the next thing to think about, or the next theme of startup equity, is that it's illiquid. It's not easily converted into cash. So when these investors are putting their money in, they're almost always expecting that their money is going to be stuck in this company until either the company is acquired, an M&A event, a merger or acquisition, or the company goes public, meaning the shares are now tradable on the public markets, a NASDAQ or a New York Stock Exchange, et cetera. Now, there are sometimes early trades. We call this the secondary market for startup stock, where there's a sale before that happens. But it's not the norm, and it's certainly not something that you could expect if you're negotiating a startup offer, that you'll be able to buy or sell these shares before there's a total sale of the company or an IPO. So the expectation has to be that the shares are not going to be liquid or tradable until there's a company-wide event. Now, how does this play out in equity compensation? This is a surprise answer. You're probably not expecting this, but the way this plays out in equity compensation at startups is that the whole world of the grant structure, all this work we're putting into structuring these grants, is designed for tax deferral, to push back the payment of taxes until there's a liquidity event and the stock can be sold. That's the underlying rhythm of all of startup compensation. That's what we're going for. We're trying to defer taxes because the stock is not liquid. So people don't want to have a taxable event where they have to pay taxes to the IRS or the Franchise Tax Board before they can sell the stock to cover those taxes. Now, you might be thinking, if you're not familiar with this area, how could I possibly owe taxes if I don't have money? Right? If you've worked for tips, you get paid money, you pay taxes. You get a salary, they take money out and you pay at the end of the year based on the money that you receive. Well, we're not talking about money, we're talking about stock. And there are events within the world of stock where you can recognize income before you have gotten paid in cash for the shares. So you owe taxes, but no money to pay it. They call this, British call this a dry tax charge, which is like dry as in you cannot squeeze, money out of this turnip or whatever, there's no, you have to pay money and it's not liquid. There's not money moving yet. So that's the underlying rhythm. So if you're listening to a course or reading a blog and we're talking about taxes, I can understand you might be thinking, well, blah, 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 blah. I'm not going to worry about taxes until I'm rich because then I'm not going to care. And that, I get it. But there is that planning necessary to defer taxes because of a liquidity problem. So there you go. Now, the next thing is the next principle or theme or secret key of startup equity is that the sale value of a stock, like what it's going to be worth when you can finally sell the stock, is unknown. It might sound obvious to you, but let's not forget that. The value can go up or down from the date that you purchase it or from the date that an investor purchases their shares. So whatever value we're talking about, like an investor paid $10 a share last month, that's a value. This investor valued these shares on that date. Or I'm going to have to pay this strike price to buy the shares. That's a value. Or I paid this strike price to buy the shares plus taxes, perhaps, if it was a taxable event. Whatever values we're talking about there do not mean what it will be worth in the future. So that's the nature of the game. How does that play out in equity compensation? Well, as in, a note of encouragement, no one has to know the future value in order to evaluate an offer today, in the here and now. Since it's not possible to know that, no one knows that, no matter what they're saying, right? You don't have to know it in order to make a good decision about your stock today. Because the way that people evaluate an offer of equity is not based on guessing what it's going to be worth in the future. People play around with that. It's certainly interesting to think about. If the company has a home run, then it will be worth, my stock might be worth this. Certainly interesting. But it's not how people who are being diligent and thoughtful about evaluating an offer make a decision. How do they do it? I'll just do a quick side note on that. Hang on. People who are looking at an offer look at it based on percentage ownership. How much of the company on a fully diluted basis is being offered to me? And then at very early stages, they would use that to compare to others within the company from a perspective, looking at it from the perspective of internal equity. Does this feel fair, this percentage ownership? Later stages, usually it's executives or key hires who are looking at the percentage ownership at a later stage company. They're looking at it based on how does this compare to market data or market based on what I know from friends of what other key hires or executives are being offered in percentage ownership at a company at this stage. So that's one angle of analysis. The other is dollar value of what's being offered to you, not based on what it'll be worth in the future, but how have investors most recently valued this company's stock? Now, you're not going to be getting the same class of stock that investors are getting, just not part of the structure of startups. They're not giving investor preferred stock to new hires. New hires get common stock as restricted stock, as stock options, as RSUs, all varieties of common stock. So you're not going to get the same type of stock that investors do, but it's a way of thinking about, okay, an investor paid let's say $10 for a share of this company stock last month, I can use that as a data point or one piece of information, one way to tell the story of how can I think about what my shares are worth today, and use that apples to apple to get some apples to apples comparison with maybe my public company stock or an all cash offer somewhere else or another startup stock offer. Getting it to a dollar value makes it feel more like apples to apples than apples to oranges. So that's another way that people do it. Now, the third way that people look at a startup offer is internal equity, sort of how am I being valued compared to others within the company? Or how am I being valued at this startup compared to the dollar value of offers that are being made at other startups? So sometimes the market data is cut instead of as percentage ownership, as dollar value of equity offers. And if you know that, then you can use that to read that data and make comparisons and think about, okay, are they really valuing my contributions here? Or would I be better off at another company that is valuing my contributions more highly? Now, of course, companies want people to think about the future value. I have seen some really hilarious emails, truly hilarious emails with companies trying to sell the future value of the offer. And certainly a conversation to have. It's interesting to talk about it, but it's not really how people think about what is the right offer today and base their negotiations, because there's no limit on what the company can say it will be worth. So it's just not grounded in reality. So another element of startup culture or principle of startup equity is that it's very competitive. These companies are fighting hard to grow and gain market share. It's a very competitive environment. You can imagine any environment where we're talking about creating billions of dollars of value out of nothing, it might be competitive, right? That makes perfect sense. There's a lot of people who want in on that game. Okay. Well, so as a result of that, these companies tend to be very secretive. And as well they should, right? If everybody knows what they're doing and how they're doing it, they're probably going to have more competitors in the market than they might otherwise have. Or their investors might not be very impressed with them if they're, blabbing their business all over town. Fair enough. That's part of the deal. So how this plays out in the world of equity compensation is that transparency is not the norm, nor should it be. Now, this is probably not very popular of a perspective among people of my vintage, because there's this whole culture of transparency. This is what people want. Well, you're not working for the government. You're working for a startup who's trying to do this amazing feat of creating something out of nothing. So people who are successful in negotiating their startup offers are very respectful of this. That being said, they do ask for information about the company, but they're very pointed in what they ask for. And most importantly, when people who are successful in these information gathering and their negotiations at startups they know what they're asking for in terms of information and why they're asking for it. So if they get a response, which is very, very normal, the company will say, often a recruiter will say, oh, we couldn't possibly tell you that. You're being very unreasonable. You could never ask for that. We could never tell you that. So if somebody is asking a reasonable question, and we'll get far into the details of what people ask for and what's reasonable as we go into the blog and the courses, but if you're asking something that's reasonable and you know why you're asking it, sort of what are you going to do with the information? Then if you get a no back, then it's easy to have a sort of conversation among reasonable adults and say, I'll need to know that information so that I can evaluate the offer based on this angle that I'm looking at. So thank you. I look forward to being in touch with the person who can't answer that question. Right? That's a little sassier maybe than most people would be, but that's the concept. You can have an adult conversation rather than a power struggle over information. I think one example would be in almost no situation is it reasonable or realistic to ask for a cap table, the company's capitalization table, as part of evaluating an offer. I can think of maybe 5 times in the last 5 years where that would have been appropriate in my world that I'm working in. But people certainly do ask for key details that would be in that cap table so that they can look at the percentage ownership or the dollar value of the equity or whatever angle they're looking at. So just keep that in mind. They're being secretive for a reason. They're not the government, and they shouldn't be telling you everything. So, the next key principle is that we're talking about private companies, as in their stock is not traded on the public markets. So the company's financials and other risk factors about the business are not disclosed to the Securities and Exchange Commission and then publicized to the public because it's a private company. Now, you'll have to forgive me a little history lesson. You can take a break if you need to, but I'll drink a sip of coffee here. The public company disclosure requirements. So if you're talking about companies that are traded on NASDAQ or the New York Stock Exchange, they have tremendous and burdensome disclosure requirements in order to be authorized by the government to sell on the public markets or authorized by their stock exchange to sell on this market, on this exchange. So everybody who's going to be watching this has grown up in an era of in a regulatory environment, they would call it, where public company information is public and strictly, very carefully scrutinized by the public and sometimes by the SEC. So it's a highly regulated environment with lots of information. Because of that, people are not used to the world of private company stock, where everything is kept very close, held very closely, close to the vest, they would call it in for playing cards. So people aren't used to that. And one of the key elements of public company stock regulation is that every time they talk about a future value proposition, what this might be worth in the future, they have to put a disclaimer on it and say, this is a forward-looking statement. As a securities lawyer, this is the name of the game. Is this a forward-looking statement or not? Are we talking about something that's true today, like an investor paid $10 per share last week? Or are we talking about something we hope will be true in the future? Like the company is going to be worth $10 billion and that investor's stock is going to be worth $1,000 a share or something. Right, forward-looking statement. So everything that's publicized by public companies needs to come with a disclaimer on that, along those lines. The reason for this is the famous stock option crash, which led to the Great Depression. I mean, a lot of people watching this, their grandparents weren't even born then. But that whole run-up of the stock market, followed by the crash, followed by the depression, was in a regulatory environment or lack thereof, where people could be straight hustling and BSing about the future value, and it created a lot of instability in the markets. So the regulatory environment today is disclose current facts. And if you're going to talk about the future, you have to put a disclaimer on that, hey, we all know that we're not talking about the truth. We're talking about a vision I am having of the future. Now, this regulatory environment does not apply in startup land. There are certainly rules against fraud, et cetera, but in the world of equity compensation, what you'll find is that there's a lot of forward-looking statements disguised as facts and misinformation. Unfortunately, this is the case. And there's really interesting writing about people who think the whole startup world should be more regulated and, all these shoulds. And I don't have any shoulds about it. I try to stay out of how things should be in this world and stay focused on how they are. And I will say that from an equity compensation perspective, the only should I have is I'll say that people who are negotiating their offers or evaluating their offers are most successful when they take responsibility for parsing the information that's shared with them, looking at it carefully, and distinguishing between fact and future fantasy, and being thoughtful about that in their information gathering. Because here's the, I'm kind of on a roll now, I've been going on a while here, but so I'm going to go on a side note on this. What you find is that the people who are sharing information about the company and in the compensation negotiations are not necessarily professionals, stock professionals. And even if they are, they're not very prudent about things, or lawyers, and they're not as careful about what they're saying as maybe they should be. And their incentives are to get people to sign that offer letter today, yesterday, So we're talking about like a car salesman type of incentive with something as sophisticated and complicated as startup stock. So the incentives are goofy, and you end up with some strange information or misinformation moving around. So because of that, the only should I have, like I said, is that it's up to the individual to ask questions and keep asking questions until they get comfortable that they've gotten the answer that they're looking for. Most of the time that means, and it varies, but getting in front of the person who actually knows the answers to the questions rather than somebody whose job it is to just say, no, we can't tell you, or kind of make stuff up. So, talking to somebody who you feel confident is an authority on the topic is helpful. It's one way to look at it. Okay, our final theme or secret key of startup equity is that the stock terms or the contract terms of a startup equity contract are not uniform. They vary from company to company to company. Now, in the world of public company stock, where you just look up the stock price on Yahoo Finance, the price that we're talking about there is for shares that are very often a totally standard form contract. Because the sometimes SEC, but more often the exchange, the NASDAQ or the New York Stock Exchange, has rules for what kind of gnarly fine print in those stock terms can end up on their exchange, because they want things to flow freely and easily and liquidly, I don't know if that's a term, in a liquid fashion, like water, moving, easy moving, turn one thing into another. That's the point of a stock exchange. That's not the case in contracts between individuals. So investors, venture capitalists, when they're making their investments, do a whole legal diligence process. Minimum would be like $25,000 of attorney's fees for looking at the fine print of their preferred stock contracts and haggling over all these fine print details that vary, from contract to contract. Now, from the individual stock perspective or the equity compensation perspective, let's just say there's contract risks on top of the risk that the company might not be successful. So people think, okay, well, if the company is successful, so too will be my stock, because I've got stock in the company, or I have options, or RSUs, or whatever it is. and they think, I am taking this risk in joining this company. Of course, the company would be having the fine print be favorable to me. That's only fair. And I think if I was coming into this world, I would probably have had that, if I was fresh in this world and had a job offer, I'd probably have that perspective too. Of course, it's going to be good for me because I'm already taking a financial risk. If it is a hit, I want my stock to be a hit too, of course. Well, unfortunately, I'll just say there's variation among contracts. The basic variation is vesting, most importantly, what happens to unvested shares in an acquisition. Tax structure, is this going to be set up for tax deferral and favorable tax treatment? When am I going to have to make the investment? Am I going to have a short exercise period if I leave the company and have to come up with this money before there's money coming to me from selling the stock? So these tax structures can get interesting. And then there can also be, we talked about vesting. How long does it take to earn the shares? But once they're earned, what rights apply to those shares? Because there can be clawbacks for vested shares and other terms that sort of strip the value from vested equity. So there's variation in the fine print. And there's also, I think, in fairness, or just to not make it sound so ominous, I think there is a sort of a cultural expectation for people who are paying attention and looking into the fine print and paying attention and negotiating the terms. If they come at it from the perspective or this spin that, hey, I'm taking a risk here, very much want to take the risk. I see the upside, but we got to nail down these contract risks so that's not a risk on top of the financial risk. People do have success in those conversations, but it does require a diligent step to make sure everything's buttoned up and that there's no surprises later on. So that's what I have for you today on these big picture startup equity terms. I hope this is helpful as you're reading the blog or taking the courses so you can see the lay of the land, have that orientation of what's going on from a high level perspective before you get into the fine print and all the weeds and things. I'll post my upcoming course topics and dates for the cohort courses underneath this video, so you'll have that to refer to if you'd like to take a course. I look forward to seeing you, and thanks for watching. Bye-bye.